Welcome to Wealth and Means, advice dressed up like hard work.
Each week, we explore ideas that help you pause, reflect, and think more deeply about the opportunities all around you.
It's the perfect mix: a little information, a few stats, some real world insights, and just enough deep talk to make you feel smarter before your second cup of coffee.
Today's episode moves the way the real world moves, sideways first, then suddenly all at once. We start with what you didn't see in the news, where mystery becomes a format, creators outrun institutions, AI video tools cross a usability threshold, agents turn prompts into actions, and geopolitics starts showing up in portfolios like a line item. Then we follow the money into small caps, unusual ETF volume, second-tier AI beneficiaries, and the pure narrative velocity of OTC flows, with a quick detour through platform fragility, recap culture, nostalgia as a signal, wellness as demand generation, and the return of the side quest. Then it's Wake Up Ready, Monday through Friday, China data, Netflix, ASML, GDP, jobless claims, PCE, and the question hiding underneath all of it: can growth and disinflation coexist into 2026? After that, knowledge bomb on why time in the market is behavioral warfare and why apps are built to turn decisions into dopamine. Then Humor Me, where finance finally admits it's been gamified, and we ask what compounding looks like when restraint stops being rewarded. Then the greater debate: steam power, railway mania, and whether progress excuses the wreckage. And finally, Let's Invent Again, Alexander Winton and the quiet invention of trust.
A quick thank you to our sponsor, Nost Moments at nostmoments.io. Share your most precious memories. Share the Nost Moments. All right, let's get into what you didn't see in the news. These aren't the stories dominating the front page. They're the ones quietly picking up velocity underneath it. First up, a pure internet anomaly. A YouTube video titled "Meet Me in Hell" that's nothing but a black screen, allegedly scheduled to run for about 140 years. The hook is simple. Nobody knows why it exists, who made it, or what it's supposed to become. The core fact is that the video itself barely matters. What exploded this week were the reaction videos, breakdowns, and speculative threads trying to decode it. The reason this matters is that it shows how attention doesn't need content anymore. It needs a puzzle. Mystery itself has become a format. And the reason it popped now is that early January is a low-noise window, which lets weird objects dominate faster than they would mid-cycle.
It's like the internet version of finding a locked door in the woods and assuming there's treasure behind it.
Exactly. And that pattern carries us straight into the next story. In the UK, creators are now outreaching traditional broadcasters like the BBC on platforms like YouTube. The hook is blunt. Legacy distribution is no longer the default. The key fact driving conversation is new reach data from late 2025 showing individual creators consistently beating institutional channels with far fewer resources. Why it matters is that this isn't just a media story. It's a labor story. Talent is learning. It doesn't need the building anymore. And it's getting attention this week because those year-end numbers are finally being digested and debated publicly. That same shift shows up again in tools. Searches for AI video generators are spiking. The hook here is speed. People want to go from idea to output without a production team. The underlying fact is that a new wave of text-to-video and image-to-video tools crossed a usability threshold late last year, and creators are now stress-testing them in real workflows. Why it matters is that video is no longer scarce. Distribution and differentiation are. And it popped this week because creators are planning their 2026 content stacks right now, not in March.
January is always new system, new me, but for creators.
Right? And once you automate output, the next step is automation itself. AI agents are moving from theory to practice. The hook is that AI isn't just answering questions anymore, it's taking actions. The key fact is that tutorials and explainers on agent workflows, things that chain tools together to actually do work, are pulling multiples of normal engagement on mid-sized channels. Why it matters is that this changes who gets leverage. Specification beats execution. And it's popping this week because new enterprise reports landed and builders are racing to translate them into usable playbooks. That technical shift bleeds directly into markets. One of the quietest but most persistent content clusters right now is geopolitics for investors. The hook is that foreign policy is being treated like a line item. The key fact is that institutions like CSIS and G0 are publishing outlooks explicitly framed around portfolios, not ideology. Why it matters is that geopolitical risk is being priced in earlier and more consciously. And it's getting attention now because 2026 outlook season has fully replaced 2025 retrospectives.
It's less what might happen and more what breaks if it does.
Exactly. And you see that same forward looking posture in markets. The January effect is back, but not as folklore. The hook is rotation. The key fact is that small cap explainers are outperforming big tech commentary and engagement even when prices are moving quietly. Why it matters is that capital is broadening again, which changes who feels optimistic. And it's peaking now because early January flows are finally visible and people are trying to interpret them before they fade. One concrete example is the SVAL ETF, which saw unusual volume without much mainstream coverage. The hook is subtle accumulation. The key fact is that volume jumped well above recent averages without a headline catalyst. Why it matters is that ETFs often tell you what narratives are forming before the narratives exist. And it showed up this week because investors are repositioning quietly rather than making loud single stock bets.
The dog food before the earnings call.
Exactly. Now, on the single name side, Pagaya saw a notable volume surge. The hook is that it's an AI credit company rising without being labeled an AI stock by the mainstream. The key fact is that trading activity spiked even though coverage stayed muted. Why it matters is that attention often migrates to second-tier beneficiaries once the obvious names feel crowded. And it popped this week because risk appetite widened just enough to let these names surface. At the extreme end of that spectrum sits AITX on the OTC markets. The hook is sheer velocity. The key fact is an enormous short-term volume burst untethered from institutional validation. Why it matters isn't the company itself, it's how narrative-driven capital behaves when friction is low. And it appeared this week because OTC flows tend to cluster right after broader risk-on signals. That fragility theme shows up again on the platform side. X experienced another bout of instability, and the hook is reliability. The key fact is that outages don't just interrupt usage, they restart conversations about exit options. Why it matters is that creators and advertisers recalibrate faster than users do. And it's resurfacing now because multiple disruptions close together compound attention.
People don't leave platforms when they're mad. They leave when they're uncertain.
Which brings us to short-form culture. The hashtag 2025 recap entered TikTok's top tier this week. The hook is reflection. The key fact is that recap templates are outperforming novelty trends, pulling participation from non-creators. Why it matters is that identity content travels farther than entertainment content, and it's peaking now because the first full work week of the year is when reflection turns into public narrative. That reflective mood overlaps with a broader nostalgia wave framed as 2026 is the new 2016. The hook is emotional shorthand. The key fact is that creators are reviving aesthetics and formats from a perceived pre-chaos era. Why it matters is that nostalgia isn't about the past, it's about signaling what people want back. And it's rising now because generational mood resets tend to happen right after calendar resets. On the consumer side, Japanese head spas are quietly trending in search. The hook is indulgence without luxury branding. The key fact is that short-form videos showcasing the experience are converting directly into bookings. Why it matters is that attention is now a demand generation engine for local services. And it's popping this week because wellness searches spike after holiday exhaustion. Finally, zooming out, there's a meta trend tying many of these together: curiosity detours. The hook is wandering. The key fact is that platforms and marketers are explicitly encouraging users to follow side paths instead of linear journeys. Why it matters is that discovery is becoming more stochastic and less optimized. And it's surfacing now because 2026 strategy decks are turning into creator experiments in real time.
Side quests are back.
That's the through line. And to wrap this up, 3 patterns stand out. First, attention is moving faster than institutions can label it, whether in media, markets, or tools. Second, curiosity is outperforming clarity. Puzzles beat explanations. And third, risk is being redistributed from platforms to creators, from mega caps to small caps, and from polished narratives to rough experiments. None of these were front page stories this week, but they're shaping what the front page looks like next month. Let's get oriented for the week ahead. This is Wake Up Ready. The goal here isn't prediction, it's preparation. What's coming? What question each event is really asking, and what moves if the answer surprises. We start with Monday. Monday, January 19th, is quiet on the surface in the US. Markets are closed for Martin Luther King Jr. Day, so equities and bonds are off. But globally, the week is already moving. China releases its Q4 GDP alongside December industrial production and retail sales. The plain English question is simple. Is the world's second largest economy stabilizing or still leaking momentum? Markets care because China sits upstream of global demand, especially for commodities, industrials, and large tech supply chains. If growth undershoots, pressure shows up fast in metals, energy, and global cyclicals. If it surprises to the upside, risk assets get a tailwind before U.S. traders are even back at their desks. One more thing to watch Monday. Oil markets stay open, but liquidity is thin. That means any China-driven move in crude can look exaggerated and carry into Tuesday.
So even on a day off, the tone's getting set.
Exactly. By the time the U.S. opens again, the table's already been laid. Tuesday, January 20th, is when the week actually starts to accelerate. On the macro side, we get the U.S. leading index for December. This isn't about what just happened, it's about the next 6 months. The key question is whether forward indicators are still pointing to expansion or quietly rolling over. Markets care because this feeds directly into recession probabilities and rate expectations. A downside surprise would reprice duration-sensitive assets pretty quickly. Then, earnings season shifts into a higher gear. Netflix reports after the close. The hook here isn't subscriber ads, it's monetization. Investors want to know whether the ad tier is scaling and whether content spend in 2026 stays disciplined. If Netflix shows leverage without ballooning costs, it supports the broader, profitable growth narrative in tech. If not, it reopens questions about margin durability across streaming. Earlier in the day, Johnson & Johnson reports before the open. This is a bellwether for healthcare and pharmaceuticals. The real question is pricing power and demand stability. If J&J shows resilience, it reinforces the defensive case for healthcare in a late-cycle environment. Progressive reports as well, giving an early look at insurance pricing and consumer stress. And United Airlines reports after the bell, which ties travel demand directly to energy and fuel consumption. If guidance holds up, it suggests consumers are still prioritizing experiences. If it weakens, that ripples into energy demand expectations.
Travel, insurance, healthcare, streaming. That's a pretty clean cross-section of the consumer.
Exactly. Tuesday is about figuring out whether the consumer is bending or holding. Wednesday, January 21st, shifts the focus to industrial and global sentiment. Early in the day, S&P Global releases flash PMI data for the US, and we also get flash PMIs from the UK, Eurozone, and Japan. The key question is whether manufacturing and services are reaccelerating or just grinding sideways. Markets care because PMIs are one of the fastest reads on real economic momentum, especially for hardware, software, and industrial supply chains. A downside miss can hit cyclicals quickly. A surprise rebound can reignite the soft landing trade. Then comes a major global earnings event. ASML reports early in the morning. This is the single most important data point for the semiconductor equipment industry. The real question isn't last quarter, it's orders. Are customers committing to future capacity or pausing? Markets care because ASML sits at the choke point of advanced chip production. Strong guidance supports AI and data center optimism. Weak guidance forces a rethink across the entire semiconductor complex. Later, Procter & Gamble reports before the open. This is about staples pricing and input costs. If margins hold, it suggests inflation pressures are still manageable. If they don't, consumer goods pricing power comes back into focus. GE Aerospace adds another layer, offering insight into aviation and defense manufacturing backlogs. And after the close, Kinder Morgan reports, giving an update on North American energy infrastructure and natural gas flows. The second order angle here is energy transition friction. Strong volumes support infrastructure names. Weakness raises questions about future capital spending.
Wednesday feels like the "is the machine still humming" day.
That's exactly right. It's a systems check. Thursday, January 22nd, is the heavyweight macro day. Everything converges here. At 8:30 a.m. Eastern, we get the advance estimate of Q4 US GDP. This is the first official look at how the economy finished 2025. The core question is whether growth slowed gracefully or cracked late in the year. Markets care because this print feeds directly into rate expectations, equity multiples, and the dollar. A hotter number pushes yields up. A weaker one brings cuts back into the conversation faster. At the same time, we get initial jobless claims, the weekly pulse of the labor market. A sudden uptick would suggest stress is spreading beyond isolated sectors. We also see durable goods orders, which tell us whether businesses are still investing in equipment and technology. If CapEx is pulling back, that hits industrials and tech hardware. If it's reaccelerating, that supports growth expectations into mid-2026. Energy traders will be watching the EIA's weekly petroleum status report, delayed to Thursday because of the holiday. Inventory surprises can move oil and gas prices quickly, especially if they confirm or contradict the tone set by China earlier in the week. Overnight, central banks step into the picture. The Bank of Japan releases its rate decision, with markets watching closely for signs of further normalization. Even a subtle shift can ripple through global bond markets. Norway's central bank also decides on rates, which matters for European energy markets and currency flows. On the earnings side, Intel reports after the close. This is a high-stakes moment for U.S. semiconductors and the PC and data center markets. The key question is whether Intel is stabilizing or still losing ground. A surprise here can swing sentiment across hardware and enterprise tech. Northrop Grumman reports before the open, offering insight into defense spending and backlog strength. And Valero reports, giving a read on refining margins and fuel demand.
That's a lot of levers in one day.
Thursday's the day that can reset the entire week's narrative. Friday, January 23rd, is about inflation and the consumer. At 8:30 a.m., we get the PCE price index, the Fed's preferred inflation gauge, along with personal income and spending. The key question is whether inflation is still cooling without crushing demand. Markets care because this print has outsized influence on the Fed's next move. A hotter core PCE pushes rate cuts further out. A cooler one reopens the door. Later in the morning, we get the final University of Michigan consumer sentiment reading. This tells us whether inflation expectations are staying anchored. If expectations rise, policymakers get nervous. If they fall, risk assets breathe easier. On the earnings front, American Express reports before the open. This is a clean read on high-end consumer spending and credit quality. Strong results suggest affluent consumers are still spending freely. Weakness hints at broader demand softening. NextEra Energy also reports, offering insight into utilities, renewables, and the power grid. Given rising electricity demand from data centers, guidance here matters more than usual. Overnight into Friday, we also get the Bank of Japan's meeting minutes, which give texture to the earlier rate decision and can move currency and bond markets as Asia opens.
So by Friday, it's inflation, consumers, and power demand all in one shot.
Exactly. And here's the big picture as you head into the week. 3 things to keep in mind. First, this is a transition week, from holiday-thin liquidity into full macro intensity. Second, the market is testing whether growth and disinflation can coexist into 2026. And third, earnings are starting to tell us which sectors still have pricing power and which don't. If you know those fault lines going in, you're already wake-up ready.
Here's a knowledge bomb that sounds boring right up until you realize it explains why most people never get rich in the market. Time in the market beats timing. The market isn't a motivational quote, it's a survival rule. Because the market isn't testing your intelligence, it's testing your behavior. And right now, the biggest thing working against that behavior is the way investing is packaged. Financial apps don't look like ledgers anymore. They look like games. Bright colors, confetti, streaks, leaderboards, constant notifications telling you something just moved and you should probably care. That design isn't neutral. It's training you to confuse motion with progress. Most new investors think the game is prediction. Find the top, dodge the crash, buy the dip, sell the rip. The apps reinforce this every time they refresh your screen and make volatility feel like opportunity. Social feeds reward whoever looks smartest in the moment, not whoever quietly stayed invested for 20 years. But the market doesn't pay you for being clever on Tuesday. It pays you for being present over decades. Here's the uncomfortable truth. Market returns don't show up smoothly. They arrive in violent bursts. A small number of days do most of the long-term work, and those days often sit right next to the worst ones. Miss them, and your returns don't just suffer, they structurally collapse. Not because you were wrong once, because you were out of the room. That's why timing fails so often. You don't just have to be right about when to get out, you have to be right about when to get back in. And emotionally, that second decision happens when your phone is screaming headlines, your app is flashing red, and your brain is wired for self-protection, not expected value. So people sell after drops, and they buy after rallies. Not because they're dumb, because the environment is engineered to push action. The long game works because it refuses to play that game. It removes decisions from moments of maximum emotional distortion. It replaces prediction with process, automation over adrenaline, fewer taps, fewer opinions, less doing something. This doesn't mean never adjusting risk. It doesn't mean blind faith. It means understanding where your real edge actually is. And for almost everyone, that edge isn't forecasting macro data, reading tea leaves, or outreacting algorithms that never sleep. It's consistency, low fees, staying invested when the app wants you to trade, letting compounding do its slow, unfair magic. If you want a cleaner way to think about it, try this. Timing the market is an intelligence problem. The apps convince you you can solve. Time in the market is a behavior problem the apps quietly make harder. And markets reward the second far more reliably than the first. That's today's knowledge bomb.
Humor me for a second. Modern finance has quietly decided the best way to help adults make lifelong decisions is to present them like a mobile game designed by a casino that minored in psychology and never met a time horizon it liked. You open a financial app, and it's immediate dopamine, confetti, green arrows. You're up $12 today. Incredible news. No one mentions that you're still down $3,000 from last month, but we don't want to kill the vibe. Meanwhile, no app has ever celebrated the single best financial decision you can make, which is not touching anything for a very long time. Silence tragically does not monetize. The system isn't built for outcomes, it's built for activity. If this keeps going, brokerages are going to introduce daily quests. Log in 5 days in a row to unlock the silver volatility badge. Trade during a market downturn to earn double emotional damage. Somewhere, a product manager just wrote that down. And the language is doing a lot of emotional labor for us. We don't say, I sold because I got nervous. We say, I took profits. We don't say, I panicked. We say, I rotated. It's financial Mad Libs designed entirely to protect your self-esteem. Here's the part that really gets me. Your app updates constantly. Your actual financial life updates maybe once a year. Raises, new jobs, kids, mortgages. None of those send push notifications. But a stock you bought on a Tuesday because someone said AI too confidently? That thing is texting you at 7:04 a.m. like, hey, we moved. You should probably feel something about this. And we pretend this is information. It's not information. It's stimulation. Information helps you make better decisions. Stimulation just makes you feel involved, which is cheaper and far more addictive. So we've created this inversion where the smartest investing behavior feels lazy. Set it up, automate it, don't touch it. That feels wrong because nothing in modern software rewards restraint. There's no badge for doing nothing, no streak for staying calm, no leaderboard for patience. If these apps were honest, you'd open them and they'd say, nothing changed, that's good. Go live your life. Maybe once a year it would whisper, rebalance, then close me again. Instead, we've trained people to confuse motion with progress, checking with managing, tapping with thinking. It's like pacing in an airplane aisle and telling yourself you're basically in Paris now. Here's my completely serious, absolutely scientific framework. There are three kinds of investors today: builders, who automate and ignore the noise; gamers, who think every market move is a boss fight; and spectators, who just watch the line move and feel feelings about it. Only one of those groups compounds. The punchline is this: the market does not care how engaged you were. It does not care how many times you checked. It only cares how long you stayed in the room. So if your investing app is trying very hard to keep you entertained, that might be your cue to do the least entertaining thing possible. Close it, humor me.
Tonight, the greater debate takes us to a different time and place. Picture London in the early 1870s. The smoke has thinned, the railways are finished, and the bill has finally come due. George Hudson is back from exile, older, heavier, living quietly after being pushed out of Parliament and stripped of his fortune, but still convinced, utterly convinced, that Britain needed men like him to drag it into the modern world. Across the room sits Charlotte Brontë, alive longer in this imagined history, celebrated for her novels, but carrying the quieter memory of family savings poured into railway shares during the mania of the 1840s and never recovered. They meet by accident at a literary salon, tea cooling between them, Hudson eager to relive his triumphs, Brontë unwilling to forget the cost. What begins as polite reminiscence sharpens into something else entirely, a debate about steam power's rise, its slow beginnings in flooded mines, its explosive takeover of factories and transport, and the speculative fever that followed. Not a debate about trains, really, but about whether progress excuses the wreckage it leaves behind. This is the kind of question that clears a dinner table without raising voices, the kind that sounds like history until you realize it's really about incentives, power, and whether progress should be judged by outcomes or casualties. The room is quiet enough to hear porcelain settle back onto saucers. George Hudson is older now, slower, still expansive. His thesis is simple, and it has not softened with age. Disruptive growth is never polite. Bubbles are not bugs, but accelerants, and history should judge builders by what remains standing, not by the wreckage left behind. Charlotte Brontë, novelist, observer of interior lives, and reluctant investor burned by the same railway mania Hudson once championed, her position is no less firm. Progress that concentrates gains and socializes losses is not destiny, it is design. Steam did not require fraud, leverage, and spectacle to succeed. Those were choices, and choices have victims. Hudson opens with confidence, the kind that once sold shares across Britain. He reminds the room where the world stood before steam, trapped in cycles of scarcity, growth tethered to muscle, animals, and the weather. For centuries, output rose and fell, but living standards barely budged. Steam broke that lock, not gradually, not politely, but decisively. Mines that once flooded became productive. Factories scaled beyond water wheels. Transport collapsed distance. Cities exploded with opportunity. He argues that the adoption curve mattered as much as the invention itself. Early inefficiency gave way to a sudden surge, and that surge required capital, vast amounts of it, mobilized faster than sober accounting ever allows. The railways were not built by patience. They were built by optimism, leverage, and a willingness to outrun certainty. Yes, capital misallocated. Yes, fortunes vanished. But the network remained. Steel stayed in the ground. The country emerged transformed. Strip away the mania, he suggests, and you don't get a gentler revolution. You get no revolution at all. There's a murmur in the room, not approval, recognition. Brontë does not rush her reply. She reframes the terrain. The question, she says, is not whether steam changed the world. It plainly did. The question is whether the way it was financed, promoted, and defended was inevitable. She points out that the same S-curve Hudson celebrates was steepened artificially by deception. Dividends paid from borrowed money, balance sheets dressed for applause, small investors invited into a game they did not understand and could not survive. The railways may have endured, but the losses were not abstract. They were household-level catastrophes. Clergymen ruined, widows wiped out, families forced into dependence. She reminds the room that technological displacement did not just move labor, it shattered identities. Skilled artisans discarded overnight, communities hollowed out, urban wages stagnant for decades while capital compounded. Progress, she argues, arrived late for those who bore its costs early. That is not fate, that is extraction wearing the language of inevitability. Hudson fires back with what once made him dangerous: scale. He concedes wrongdoing without conceding guilt. Yes, accounts were massaged. Yes, leverage ran hot. But he insists that moralizing the past misunderstands the mechanism. Innovation does not diffuse at a socially comfortable pace. It surges when belief outruns proof. Financial manias are how societies prepay for infrastructure they cannot yet justify with cash flow. The crash was brutal, but it forced discipline. Bad promoters fell. Good lines survived. The country emerged with a national transport grid that no cautious parliament would have funded line by line. He delivers his first real blow when he turns her argument inward. Without the urbanization, literacy, and surplus steam enabled, there would be no mass readership, no publishing industry capable of sustaining her career. The society that harmed her family is the same one that elevated her voice. That contradiction, he says, is the cost of scale. The room tightens, this one lands. Bronte does not flinch. She acknowledges the tension directly. Yes, steam expanded literacy. Yes, markets for ideas widened. She admits that her work benefited from the very forces she critiques. But she draws a line between consequence and justification. That an unjust process produces cultural flourishing does not absolve the process. She presses where Hudson is weakest: agency. The bubble was not an emergent property of steam. It was engineered through incentives that rewarded speed over truth and scale over stewardship. The railways could have been built slower with lower leverage, broader protections, and fewer false promises. They were not because speculation was profitable for insiders. When the crash came, the losses were not shared proportionally. Capital regrouped. Labor absorbed the shock. She calls this the original sin of industrial finance. Privatized upside, dispersed ruin. Progress did not demand that bargain. Power did. Hudson pauses. For the first time, he gives ground that matters. He admits that speed blinded him, that in chasing network effects he ignored fragility. That leverage created a moral hazard he did not fully understand until it consumed him. He acknowledges that trust, once broken at scale, scars a generation, but he refuses the final indictment. He argues that restraint, had it prevailed, would have ceded advantage to nations willing to move faster and dirtier. Steam was not adopted in isolation. It was a geopolitical race. Delay meant decline. Britain's lead was not guaranteed. In his view, the ethical failure was not ambition, but the lack of institutions ready to absorb its consequences. Better laws, better disclosure, better safety nets, not less disruption. Bronte meets him there, and the temperature changes. She concedes that institutions lag technology, that societies often learn governance only after damage. Her weakness, she admits, is hindsight. It is easier to design fairness after wealth exists than before it does. But she holds her final ground. If we accept that harm is the tuition fee for progress, we stop asking who sets the price. Steam did not force fraud. Railways did not require theatrical optimism. Those were cultural choices reinforced by financial rewards. The lesson of the steam age is not that bubbles build futures, but that unchecked incentives shape who the future belongs to. The silence now is heavier, not uncomfortable, productive. I step back in, not to declare a victor, because debates like this don't end that way. Hudson reminds us that growth at civilizational scale is messy, nonlinear, and often financed by belief before proof. Bronte reminds us that belief, when monetized without restraint, leaves human wreckage that numbers alone can't redeem. One sees infrastructure as the ultimate ledger. The other sees trust as the scar tissue that never fully heals. Steam broke the Malthusian trap, yes, but it also taught us that the curve of progress bends differently depending on who bears its volatility. The room exhales, tea goes cold, and everyone leaves carrying the same uncomfortable thought. The next general-purpose technology is already climbing its curve. And that is the greater debate.
Let's invent again. Alexander Winton did not start with a grand vision of transforming America. He started with irritation, with wasted motion, with the sense that the machines around him were almost good enough, and that almost was the problem. Born in industrial Scotland and arriving in the United States at the height of mechanical optimism, Winton was a builder in an era when horsepower still meant literal horses, and the street was as much stable as thoroughfare. The world was loud, slow, and stubborn. Progress existed, but it was fragile, unreliable, and constantly breaking down at the seams. Winton's early work was not glamorous. He built bicycles. He obsessed over bearings, chains, balance, and friction. He learned where energy was lost, where materials failed, where design choices created hidden costs for the person using the machine. That apprenticeship mattered. Because when he turned his attention to the horseless carriage, he did not approach it as a spectacle or a novelty. He approached it as a system that needed to work every day, for people who did not want to think about the machine at all. At the time, the automobile was not an inevitability. It was a curiosity imported from Europe, fragile and temperamental, more likely to impress at a fair than to survive a bad road. Most people assumed it would remain a toy for the wealthy, or a brief experiment before the horse reclaimed its place. The constraints were obvious. Roads were terrible, fuel was inconsistent, parts were bespoke, reliability was a fantasy. The prevailing wisdom was that scale would come later, if at all. Winton did not argue with that wisdom. He sidestepped it. Instead of trying to build the perfect car, he tried to build a sellable one. Instead of chasing maximum speed or novelty, he chased dependability. His early gasoline-powered bicycle was not about thrill. It was about proving that an internal combustion engine could be controlled, restarted, regulated, and trusted. When he broadened that idea into a car in the mid-1890s, the insight carried forward. His design choices were practical and disciplined. A vertical two-cylinder engine, a friction clutch, electric ignition, a carburetor that behaved, pneumatic tires that absorbed punishment rather than transmitting it. None of this sounds revolutionary in hindsight. That is the trap of successful invention. We mistake familiarity for simplicity. But in 1896, this was a statement. Winton was asserting that a gasoline-powered vehicle could be predictable, not just possible. That it could start when asked, stop when commanded, and survive imperfect users on imperfect roads. That it could be a product, not a prototype. The real break came in 1898, when Winton sold his first car for $1,000. That sale matters more than most patents. It was the first time a gasoline automobile was sold in America to a member of the public. Not demonstrated, not promised, sold. Money changed hands. Expectations were set, accountability was created. This is where Winton separates himself from the mythologized inventors who dominate our collective memory. He did not wait for the market to mature. He forced it to exist by taking responsibility for the outcome. When the Winton Motor Carriage Company formed, its purpose was not to dazzle. It was to deliver an improved, dependable model to people who expected it to work. That expectation shaped everything that followed. Winton understood something subtle and rare. Innovation is not just about making something new. It is about making something boring in the best possible way. Reliable, predictable, trustworthy. His work on braking systems is a perfect example. External and internal brakes on the same drum sound like an incremental tweak. In practice, they standardized safety in a way that allowed drivers to push the machine without constantly fearing failure. That design became the standard, not because it was clever, but because it reduced cognitive load for the user. This pattern repeats throughout Winton's career. He held more than 100 patents, but the through line is restraint. He did not chase novelty for its own sake. He chased leverage. Where can a small design decision remove an entire category of risk? Where can an unseen improvement compound across thousands of uses? Even after achieving success in automobiles, Winton did not settle into legacy maintenance. He turned his attention to diesel engines. Again, the context matters. Diesel was not fashionable. It was heavy, industrial, unromantic, but it was efficient, durable, and scalable. In 1913, Winton's company produced the first American-made diesel engine. That engine did not change how people commuted, but it changed how industry moved. When General Motors acquired Winton's diesel factory in 1930, the technology went on to power railroad engines for decades. There is a temptation to frame Winton as a precursor to Henry Ford, to cast him as a footnote before the real story begins. That misses the point. Winton was not trying to invent mass production. He was inventing trust. He proved that Americans would buy a gasoline automobile if it behaved like a product instead of an experiment. Ford scaled that insight. Winton made it credible. This distinction matters today because we live in an era obsessed with scale before substance. Startups race to distribution before reliability. Platforms chase growth while quietly accumulating technical debt and user distrust. Winton's work reminds us that markets are not unlocked by ambition alone. They are unlocked when users stop worrying about failure modes. His cars did not win because they were the fastest or the cheapest. They won because they reduced friction in the broadest sense. Mechanical friction, yes, but also psychological friction. The anxiety of being stranded, the uncertainty of whether a machine will obey, the embarrassment of owning something that feels unfinished. Winton built machines that respected the user's time and attention. That respect is the quiet engine of adoption. Look at modern technology, and the echoes are everywhere. The products that reshape behavior are rarely the most advanced on paper. They are the ones that disappear into habit, the ones that fail gracefully, the ones that make complex systems feel inevitable in hindsight because they remove just enough uncertainty to cross the threshold of trust. Winton operated under immense constraints: primitive infrastructure, skeptical customers, immature supply chains, no established market to validate his choices. He did not overcome those constraints by ignoring them. He designed directly into them. He treated unreliability as the core problem, not a secondary inconvenience. That is the lesson worth carrying forward. Innovation compounds when it aligns with human tolerance, not human aspiration. People do not adopt systems because they are impressed. They adopt them because they stop thinking about them. Winton understood that progress does not announce itself. It settles in quietly, one dependable experience at a time. So the next time we talk about reinvention, about building again, it is worth asking a different question. Not how fast can this scale or how novel is this idea, but where is the friction that everyone has accepted as normal? Where is the failure mode that people have learned to work around? Because that is where the leverage hides. Alexander Winton did not invent the future by shouting about it. He built it until it behaved. And once it did, the world followed. That's it for another episode of Wealth and Means, advice dressed up like hard work.
We hope you enjoyed the full arc: attention that outruns labels, tools that turn ideas into outputs, markets that price risk before headlines can name it. Then the calendar tightens, the data lands, the consumer gets tested, and the only real edge left is behavior. Not prediction, not performance, behavior. The debate on steam makes the uncomfortable part explicit. Progress does not arrive evenly, and the way it's financed shapes who it belongs to. And Winton lands the counterweight. The breakthrough is rarely the flashiest mechanism. It's the moment a system becomes dependable enough that people stop thinking about it. Curiosity pulls you off the main road. Incentives decide who gets paid for it. Trust decides what sticks. In the long run, wealth follows what is boring, robust, and repeatable, and so does progress.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you, to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, Nost Moments, because the best investments are still your memories.
Until next time, stay curious.
Stay kind.
And keep compounding.